Recently, claims have emerged suggesting that the XRP chart is forming a setup visually similar to what was observed in 2017. This comparison has naturally sparked considerable interest within the crypto community, leading many to question if history is about to repeat itself. We will explore what these claims entail and why this comparison exists, while also examining where this reasoning might break down. To understand this comparison, we first look back at 2017. XRP's price action then showed a distinct five-wave corrective sequence, characterized by declining odd waves and temporary rebounds in even waves. Specifically, the fifth wave compressed into a falling wedge pattern, stabilizing around 0.00485, which was below its previous low. This period was marked by contracting volatility and a fading downside momentum, setting the stage for a significant market shift. This period culminated in a falling wedge pattern, where volatility contracted and downside momentum faded significantly. This led to a decisive breakout that ignited a rally exceeding 1,000%. The price reclaimed key levels, moving from 0.008 to 0.02, ultimately peaking near 3.84 in January 2018. This explosive move is what many are hoping to see replicated today. Now, observers are pointing to visual parallels in the current XRP weekly chart. On the surface, it appears to mirror the compression and fading downside momentum seen before the 2017 rally. Analysts highlight a similar five-wave corrective structure and a falling wedge pattern, suggesting a potential for a comparable breakout. This visual alignment is the primary driver behind the current speculation. What people mean by the same setup often refers to specific technical analysis patterns. This includes Elliott wave theory's five-wave correction, which describes a specific sequence of price movements, and falling wedges, which are typically bullish reversal patterns. Additionally, similarities in support and resistance levels are noted, along with other indicators that suggest a similar market structure is developing. They also note contracting volatility, akin to a Bollinger Band squeeze, where the bands narrow significantly, indicating a period of low volatility often preceding a large price move. Furthermore, RSI divergence, where higher lows in the relative strength index suggest weakening bearish momentum despite price making lower lows, is another key indicator being cited as a parallel to the 2017 setup. However, it's crucial to consider the market conditions of 2017, which were vastly different. That year saw a nascent crypto market, an overall bull run, and significant XRP catalysts like Ripple's MoneyGram partnership pilot and SBI Holdings integration in Japan. These factors created a unique environment for XRP's explosive growth, which is important context for any comparison. The crypto market cap exploded from around $300 million to over $130 billion in 2017, fueled by an ICO boom, low regulation, and widespread retail FOMO. Bitcoin itself rose from approximately $775 to nearly $19,800, creating an unprecedented bullish sentiment across the entire digital asset space. This environment provided a fertile ground for altcoins like XRP to achieve massive gains. Today's market conditions present a stark contrast. We are in a more mature market, post-2022 bear winter, with a different regulatory environment and evolving adoption stages. The market is significantly larger, with deeper liquidity, and institutional involvement is far more prevalent, which fundamentally changes how assets move and react to catalysts. Macroeconomic factors, such as elevated Fed interest rates and geopolitical tensions, also play a much larger role now than they did in 2017. These broader economic forces can exert significant pressure on risk assets like cryptocurrencies, influencing investor sentiment and capital flows in ways that were not as prominent during the earlier bull market. This adds another layer of complexity to current market dynamics. This is where the reasoning behind visual similarity often breaks down. While chart patterns can repeat due to human psychology and predictable market behavior, the underlying fundamentals and broader market forces are significantly different. Relying solely on visual patterns without accounting for these fundamental shifts can lead to misinterpretations of future price action. For instance, a 1,000% gain from XRP's 2017 low of 0.05 led to a market cap of around $130 billion. A similar percentage gain from today's higher base, say from $2, would require an improbable influx of capital, pushing XRP's market cap into the trillions. This highlights the scale effect, and why replicating past percentage gains becomes increasingly difficult in a larger market. The scale effect means that achieving similar parabolic moves is far less likely in a market with deeper liquidity and a much larger existing valuation. The capital required to move a multi-billion-dollar asset by 1,000% is exponentially greater than what was needed for a much smaller asset in a nascent market. This fundamental difference in market size and liquidity cannot be overlooked. In conclusion, while visual chart patterns can offer intriguing comparisons and highlight potential technical setups, it is vital to separate these similarities from the actual market conditions and underlying forces at play. A thoughtful analysis requires looking beyond just the charts. The 2017 rally was driven by unique catalysts in a nascent market, conditions that simply do not exist in the same form today. Encouraging skepticism and a calm analytical approach remains paramount when evaluating such claims. It is crucial to understand that while patterns may rhyme, history rarely repeats itself exactly, especially in dynamic markets like cryptocurrency.